It's a correction after 9 straight runs. Look, the Fed saw 5% or Yellen saw 5% bond yields and took fright. The Fed flooded the system again in November, the repo game this time. And you have a lovely, beautiful rally. I think I was only on a few weeks ago, Karen, and I think I said to you, stay involved. And it is one of those moments you just have to sit there, hold your nose and participate. Individuals are buying the MAGA 7 in the highest proportion they ever have. It's just a chase of momentum and liquidity. And the Federal Reserve is accommodating Yellen's wishes. I don't think it's that complicated. I don't agree the market decided this. The market was absolutely falling to bits at 5% yield, and then the Fed got nervous. Something didn't quite break, but it got close. And they decided no. So they flag rate cuts next year. I don't believe it. I'm with the Philadelphia governor. I think it's nonsense. The US economy, if anything, is reaccelerating. I just think it's la la land, to use a perhaps an appropriate phrase. I don't think there's going to be rate cuts as early as people think. I don't think there's actually a particularly meaningful slowdown in the US. I love the fact economists are apparently surprised by things. Well, get used to being surprised. I don't think it's a slowdown. I think Asia's also picked up. Europe and UK is slightly different. I think there is an element of that. But even in the UK, there seems to be signs that things are okay. So I'm not convinced the world's falling apart and that the bond yield is telling you the right story about, soft/hard landing.
Peter, if you hold that view and you have a view that the re-rating around monetary policy is incorrect at this stage, how aggressively would you sell this rally that we've had in recent weeks?
It's a momentum rally. And at some point, everyone's going to wake up and realise the economy is not falling apart. By the way, for earnings, that's not necessarily a bad thing. I think the issue is that you're driving the same stocks continuously higher, Karen. And, we've talked about this constantly through time. I have stuck with the idea that you stay with value. I don't think that's going to change. I think in the US, you've got to balance that up with the fact that the MAGA 7 keep driving the market higher. I think the S&P is only up 6% if you take out the Magnificent Seven this year. So that's interesting in its own right. I'll go back to the old line. Most, Japan, Japan, UK, GEM, the emerging markets, they're not particularly expensive. If we're going to have an inflationary-ish style boom next year, and I don't think that's probably out of order, then you need to think about what you're owning. And I don't think it's going to be particularly long duration assets you're going to want. I think it might still be more of those value, economically sensitive stocks. Probably some of the small mid caps, which have been absolutely crushed, are probably interesting for next year. That's the style in which I'd play it for next year. I think you have to stick with what I think continues to be the case, that you want to favour value over growth. It's been right in 3/4 of the markets in the world this year, just not right in the US, where value has really, really struggled because, once again, people are obsessed with AI and they're obsessed. You need a good story and lots of liquidity. And at the moment, the story is AI, and the liquidity is being gratefully provided by the Federal Reserve.
Yeah, Peter, good morning to you. Have we gone back to perhaps what is somewhat normal here, where, for much of this year, good news was kind of bad news and vice versa? Are we perhaps getting back to a level where good news will become good news again and bad news pretty much the same, particularly when you look at that inflation number?
Well, inflation is definitely, on a year-on-year basis, it is definitely, obviously it was going to come down from what it was a year ago or even 6 months ago, but I'm still sticking to the story of the core rate is not doing what the Fed wants. If you look at some of the numbers, you can even see that on the 3-month view, the core number's actually up. And I think people aren't looking at the fact that we haven't broken the back of it. The break-even's at 2%, which is what they're saying on a 10-year, is nonsense. I just think we're going to have sticker inflation. It's not the end of the world, by the way. I don't think it matters that inflation is going to be perhaps higher than 2. I don't think they're ever going to get back to 2. And we've got no slack in the labour force. I mean, it's just amazing how many people are expecting a huge pivot. As though we've got huge pools of labour everywhere that can just be soaked up in the inevitable continuous recovery. I just think it's nonsense. I don't believe it's correct. I think we have a problem in terms of a longer term inflation trend, transition, energy transition in particular, equality, where people are fed up with not being paid properly. And I think that is true, that the people are homeless in America because they don't get paid enough. Ditto probably here in some respects. You're going to have a repointing of labour against profitability. And all those trends are going to play for this decade. And I think for the moment, People are hoping for a slowdown, rates back to 2, possibly even QE, which is broadly what you've had from the Fed in terms of their latest antics in the repo market. And so you've got a liquidity flush because I think we're all scared of things going wrong. And they think they've cracked the back of inflation. I think the story for next year is that they probably haven't. So be more cautious than you have been this year. This year was relatively easy after a grotty 22. I think next year is going to be lots more lumpy. And for me, I'd still stick with the value side of the equation, not the growth side. Shorter duration assets, not longer ones.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.